All right, guys, we are going to be going over the next session here in just a minute. But before we get into that, let me know in the chat, what was your guys' favorite part of Tommy's session? Let me know your favorite takeaways, your favorite part of it. Anything is fair game. Just let's see what the people have to say before we get going. The business structure, yeah, that's one of my favorite things is seeing everything kind of mapped out, the holding company, the LLC, and that's something that I think a lot of us need to implement. But once I implemented that, man, it's a game changer. The holding setup, yep. The structure, business structure, yeah, 100%. I think that's one of the things that's most overlooked, to be honest, is protecting everything, right? Because we work so hard to build everything, we build this legacy, and then literally one lawsuit could just completely derail it all. So that protection of everything with the trusts, the wills is a complete game changer and something that a lot of people overlook. So I hope that's something that a lot of us is going to be able to set up here. Okay, guys, cool. So, before we get going here on this next session, let me know if you guys can see my screen, if you guys can hear me all right before we get going on this next session. Awesome. Good deal. Okay, guys, are we ready to get going? I feel like the people here, I love the energy. You guys are just like ready to get going on the next step. Are you guys ready to get going on this next session here? Yep. Okay. Awesome. Okay. But we're not going to waste any time. I want to be efficient with your guys' time as well. So I'm just going to do what the people want. Okay. So in this session, I'm going to show you how to start a 100% tax-free short-term rental business without quitting your job. And look, everything we've covered today so far, those are foundational strategies, right? So you're optimizing, you're keeping more of what you earn, you're plugging the leaks, and they're optimizing the path you're already on. Now, short-term rentals is the accelerated path. Okay. This is the jetpack, the booster that breaks the entire ceiling. So this is going to help you build wealth faster than your W2 could ever can, and also use the tax code, and it's going to reward us for using this. Okay. So instead of just like slowly building wealth over 30 years, this is going to let you compress that timeline by a whole lot. Okay. By sometimes 3 to 5x. Now, if some of you guys are thinking, okay, I don't want to do Airbnbs, this isn't for me, totally fine. Okay. I still recommend you going through this because I'll break down my full analysis of other real estate models as well. And at some point, everyone deals with real estate at one point or another, right? You're going to buy a house, rent it out, look at a second property, and you already grabbed your challenge ticket. So you might as well see how this works. This is coming from someone that's built an 8-figure real estate portfolio without inheriting any of it. And so if you're not into real estate, but you're curious about starting a side business, you're going to see exactly how I run my operations here. And then also how you can get the tax flow benefits, the equity benefits, and then also the tax savings, which is a huge one. Okay. So I promise you this session will be worth it. Now, before we start, another disclaimer, just like Tommy said in the last session, I promise I'll keep mine shorter. Everything I share here is for education only. I'm not promising you're going to get the same results. Now, before we start, the quick disclaimer. So everything I'm showing you is just what's worked for me. And for people who follow this process, my goal is to give you the understanding of how this works so you can decide if it's for you. So with that being said, let's get into it. So today I'm going to show you the steps you can take so you can make it work, even if you're a complete beginner, or if you've always tried a side hustle and maybe it didn't work out, or even if you have a really busy schedule. Because whenever I suggest someone start a business, I often hear things like, I don't have a time or enough time to run a business. I have a 9 to 5, or I'm running something else. But once your property's up and running, it only takes about an hour per week to manage. For example, one of my students, Rob, he has 3 properties, cash flowing over $10,000 per month. And so once your property is set up, it takes a couple hours per week to manage, right? And so just an hour of that could help you build a cash flowing portfolio. And back when I was working a W2 job, I was literally calling landlords on my lunch breaks. So it's not just about finding the time, it's about setting priorities. Now, another thing is I've never run a business before. I'm new to real estate. Okay, you don't need any previous experience to succeed with this business. That's one of the best things about this. Or I don't know how to find the right property or build a team. I'm going to share with you the exact systems that I use, so that's not going to be a problem either. And so here's what I'm going to cover in this session. Okay, I'm going to go over first the problems with the traditional real estate models based on my own experience. Then I'm going to talk about a little known IRS loophole to create a tax-free Airbnb income stream. Then I'm going to go over the 4 pillars to build a 5-figure per month business with properties you don't have to own. This is going to include how to find the right property, how to negotiate the deals, how to set up your Airbnb remotely if you're in a restricted area, and most importantly, how to automate this so that way you're not having to work in this every single day. This presentation is going to cover most of the questions you probably have, and also if you have more, we're also going to do the Q&A here later as well. So first, my goal here is to show you how to use short-term rentals to set up your first $2,500 a month property so you can replace your 9-to-5 income with a business that requires far less time commitment. Plus, show you the path you can follow to scale this business to $100,000 per year and beyond semi-passively. Now, before I get into all that, I want to show you something interesting. Okay, we already had several tax sessions here already, but there are a few more tax strategies I haven't talked about. And these are the ones tied directly to real estate, can also be used with short-term rentals, both arbitrage and owned. So I'm going to give you a quick walkthrough of the four of them. Let's start with the first one here. Okay, this one's super powerful. Okay, it's simple. Tommy talked about it here a little bit in the last session, but the Augusta rule lets you rent out your personal home to your business for up to 14 days per year, and that rent is 100% tax-free. So let me dive a little bit deeper into this. Again, this comes from Augusta, Georgia. It's where the homeowners rented out their houses during the Masters tournament, and IRS made it official. Now, anyone with a business can do the same here. Here's how it works. Your business rents your house for meetings, planning sessions, or small events. You charge a fair market daily rate, just like a venue would, and then the business deducts the rent as an expense. Now, you personally don't pay any taxes on the money you receive. And if your business pays you $1,500 per day for 14 days, that's $21,000 that's tax-free in your pocket every year. Even at $1,000 a day, you're still pocketing $14,000 tax-free. So first, you want to check local venues or Peerspace listings to see the going daily rates. You can draft a short rental agreement between you and your business listing date. You also want to do the rate and also the purpose. Really, really important. And then create a meeting agenda or notes for each date as proof. You want to invoice your company, pay yourself from the business account. And then 5, keep all the paperwork together, the rate research, the invoice agenda as well. Now, who can use this? This works for everyone with an LLC, business, including Airbnb operators, and it applies whether you do arbitrage or own your properties. It's based on your personal home and not the rental units. All right, this is one of the biggest tax advantages in real estate, and it works perfectly with short-term rentals. So the short-term rental loophole lets you use losses from your business to offset your W-2 or your 1099 income, even if you're not a full-time real estate professional. Let me say that again. The short-term rental loophole lets you use the losses from your Airbnb business to offset your W-2 or your 1099 income. Okay, that's huge because normally rental losses can only offset rental income. The IRS treats short-term rentals average stays under 7 days as an active business and not a passive one. So that means if your Airbnb shows a paper loss, usually from depreciation, furniture, or startup costs, you can deduct that loss against your job or your business income. Now, if you actively participate in the management, roughly 100 hours a year or more than anyone else, then you qualify. So here's an example. So let's say you make $200,000 per year from your job. Your Airbnb shows a $50,000 loss after deductions and depreciation. You can subtract that $50,000 from your taxable income, saving anywhere from $15,000 to $20,000 in taxes, depending on your bracket. Now, before deductions, approximate tax was $60,000 to $70,000. But after the Airbnb deductions, taxable income dropped by $50,000. You're going to save $15,000 to $20,000 in taxes, which is huge. Now, here's how to set it up. First is the material participation. You need to log your hours spent managing the property, handling the guests, coordinating the cleaners, or updating the listings. Now you want to properly classify. So you want to confirm your average stay is 7 days or less. Airbnb is going to handle this automatically. You want to keep track of records, so keep track of all the expenses, upgrades, improvements. They're all going to count towards deductions. And then fourth, you want to work with a CPA who understands short-term rentals to file this correctly. Then finally, keep all the paperwork together, the rate research, invoice, and agenda. I did this. I made $500,000 in income in that year. I had $500,000 worth of depreciation that I was able to deduct from that. And so in that year, I literally paid $0 in tax, but also my business that year made $250,000 in income. So you don't have to actually take these losses against your income. You literally get to keep it. And so I'm going to show you a little bit here how to stack that with bonus depreciation and cost segregation. All right. So what this means is breaking down your property into smaller components instead of treating it as a long-term asset. So different parts of the property wear at different speeds. And so the IRS allows you to depreciate them faster. So you're separating things like furniture, appliances, lighting fixtures, flooring, cabinetry, landscaping, etc. And so once those are identified, you get the bonus depreciation, which allows you to deduct a large percentage of those items immediately in the same year you buy the property, right? So this is where it gets powerful. So thanks to the Big Beautiful Bill Act signed in July 2025, bonus depreciation is now permanently at 100% for qualifying property acquired and placed in service after January 19th of 2025. So whether you're filing for 2025 or making moves in 2026 and beyond, you're going to get the full write-off. So here's how it works. Let's take an example. Okay, so let's say, again, you buy a property, $500,000, cost segregation study shows that about $200,000 of that amount is going to be tied to the short-term assets like the furniture, flooring, fixtures, etc. Now, here's what happens next. You apply 100% bonus depreciation on those short-term assets. That means you can deduct $200,000 in year one. So total savings on tax assumes a 35% tax bracket is $70,000 in total tax savings. Now, the rest continues to depreciate normally over the coming years. And remember, these are paper deductions, right? You're not losing money in real life. You're simply lowering your taxable income while keeping your cash flow intact. And here's how this sets up. So first, you want to hire a cost segregation firm or CPA that handles real estate. They're going to send a specialist or an engineer to analyze the property and then prepare the report. You're going to share the report with your CPA. They're going to claim the deductions correctly when filing your taxes. And you want to make sure that you keep the documentation. So the report, purchase records, and receipts for the improvements. This only applies if you own the property. It doesn't work for arbitrage since you're leasing but not owning. And it's best paired with the short-term rental loophole because depreciation losses can offset your active income. Now, I want to go over why I prefer this real estate model over others. Because over the years, I've tried BRRRR, house hacking, assisted living facilities, wholesaling, fix and flip. And I've made money with all these, and they helped me build an 8-figure real estate portfolio. But after 4 years and millions of dollars spent, I realized that I was doing it the wrong way. All right. So the problem with all these models is that they have large upfront investments because you need hundreds of thousands in cash or tied down to huge mortgages. And here's a duplex I bought back in 2019. I followed the BRRRR method. I got a $135,000 loan, additional $30,000 in credit lines for repairs. Monthly payment came out to $1,215 per month, and the rent that was coming in was $2,295 per month. Now the expenses, property management, property taxes, insurance, operating costs, plus if something went down like an AC, that's another $1,000 right there. Now, when I rented it out after a few months, I was making $500 per month, had a partner in it. My cut was $250 per month. Now, the second problem here is that there's little to no monthly income. As you saw from that example, I was making $250 after putting in, $80,000 in capital, right? Plus, you need additional capital to scale this to make this meaningful. Plus, from a beginner's perspective, these models have a lot of moving parts. You're not going to see real appreciation for at least a few years, and it feels like you have a second job. And most importantly, you need to wait another 5 to 7 years minimum to quit your job so you can live off the income. And sure, the tax benefits and equity are good, but if your only problem if your only income is from your job, then you have bigger problems. And that's building cash flow. And that's what pays the bills, keeps the food on the table. And that's what most people don't realize. And I didn't really either. So instead of focusing on building cash flow first, I focus on building equity and getting paper rich. I own most of the street behind here on this picture. And that's because I inverted priorities because I didn't know better. And I was still stuck with the low cash flow problem. And so that's why me and my wife were still working at our 9-to-5s, even after investing hundreds of thousands of dollars to buy properties. She was going to work during COVID, even while she was pregnant. And honestly, that was the last straw for me. And that's when my priority became building a reliable cash flow stream that I could manage alongside my job. And that's when I came across short-term rentals. Okay, so I started digging into this industry, and here's what I found. So in 2021, at the peak of COVID, Airbnb still hit 193 million bookings. 2022, demand grew by 30% year over year. In 2023, the short-term rental market exploded to $64 billion in revenue. That's more than all the movies that were released in 2023 combined. 2024, the uptrend continued, and it's expected to grow from $131.45 billion to $145.73 billion this year. And it's forecasted to reach $244.13 billion by 2031 at a 10.86% CAGR over those years. So to put this number into perspective, I know that I threw a lot of numbers at you. The global short-term rental market is on track to hit around $150 billion this year. And to put that into perspective, that's roughly the same size as the entire US pet industry, which sits at about $157 billion right now. So when you hear people say, Airbnb is dying or the short-term rental market is saturated, they're just wrong, right? Because every single year there's a new headline that claims that it's over. During COVID, the narrative was no one's staying in properties, hotels are cheaper, but the data speaks for itself. Okay, this is a massive established industry that keeps growing. And more importantly for you, it comes with some of the most powerful tax strategies in the entire tax code. But the real question you're probably asking is why? And the answer is not merely because people are traveling more often. It's because travel itself has changed. Back when I was a kid, we took one trip per year and that was it. People these days are traveling year round, even during off season. People are scrolling through Instagram, TikTok, and seeing the friends, celebrities, influencers, they're all traveling. And so people see others traveling, and now they want to travel themselves. They book trips, they post about it, and the cycle repeats. And when they travel, they're looking for these unique themed stays, secluded escapes like a rural cabin, spacious homes for big families. And when you think of these things, the things that come to mind is Airbnb, right? And so according to a study, the younger generation prioritized travel over buying a home or even paying off debt. Now, here's the short-term rental model and how it works, right? So you rent out a property for 30 days or less on platforms like Airbnb, VRBO, Booking.com, and then you make money from the bookings. So you get it. It's pretty straightforward. And there are two ways to do this model, okay? First is the ownership path. Okay, you buy the property. The second path is arbitrage, aka the bridge method. You rent it from someone else. Now, here's why homeownership works for high earners. Let's say you're making $150,000, $200,000, $300,000 plus per year at your job. Ownership might be the better play from day one. And here are 4 reasons why. The first reason is you get the tax benefits. So the short-term rental loophole, the cost segregation, and the bonus depreciation that we talked about, those strategies only work if you own the property. With arbitrage, you get the cash flow, you're paying taxes on, but you're paying taxes on every dollar. But with ownership, you get cash flow plus the paper losses that wipe out taxes on your W-2 income. Here's what it looks like. So again, we went through this example here. $200,000 per year. Let's say your tax bill is going to be $50,000 to $60,000. You buy a $500,000 short-term rental. Cost segregation identifies $175,000 in accelerated depreciation. So you get to write off the entire $175,000 in year one. And so your taxable income drops to $25,000 and your federal tax bill comes out to $2,800. So you went from paying over $50,000 in taxes to under $5,000. That's $45,000 to $55,000 back in your pocket in year one while the property generates cash flow. That's why this is so big. The second reason is you get to build equity. Every mortgage payment has 2 parts, the principal and the interest. And the interest goes to the bank. Principal builds your ownership stake in the property. So let's take a look at the math. Let's say you have a $400,000 loan at 6% over 30 years. Your monthly payment comes out to about $2,400. So year one, about $4,900 goes to principal. Year 5, $7,000 a year goes to principal. And by year 10, nearly $13,000 per year goes to the principal. This is forced savings. Okay, that's how I like to look at it. It's like a forced piggy bank. Your guests pay the mortgage. Every payment increases your ownership stake. And with arbitrage, you pay the rent. That money is gone, zero equity. The third reason here is you get appreciation. Real estate values increase over time. Now, historically, over time, it's about 4 to 5% per year. Let's be conservative. Let's use 3%. So a $500,000 property appreciating at 3% per year, we're looking at by year 10, it's going to increase to $171,000 in equity that you get. And you didn't have to work for that, right? The property just grew. And here's a real thing, or a real kicker. You're getting appreciation on the full $500,000, even though you only put down $100,000. So that's really the leverage. And that's why I love real estate, is because you get that leverage. Now, the fourth reason is you have multiple exit strategies. When you own the property, you can control what happens. The first option is you get to keep it and collect cash flow. So the property generates income month after month. You never sell, pass it down to your kids, generational wealth. The second option, you can sell it. So let's say the market goes up, you build equity, you cash out, take the profit. And if you lived in the property for the last 2 of the 5 years, up to $250,000 is of the gains is tax free. $500,000 if you're married. That's a primary residence exclusion. Or let's say the third option, you can refinance it. Property value goes up, you refinance, you pull out tax cash free, and then use that cash to go and buy another property. You still own the original, but now you have two properties. Or the fourth option is 1031 exchange. So you can sell the property, but you can defer all the capital gains taxes by rolling the proceeds into another investment property within 180 days. The IRS lets you keep upgrading properties without paying taxes until you eventually cash out for good. Now, let's talk about how the arbitrage bridge method works, okay? So, first part is you find a property, you rent it out, furnish for Airbnb, and then you list it on Airbnb, have guests staying over, and that way you can start generating consistent cash flow by using other people's properties to become financially free. Now, you might be wondering, why would the landlord let me sublease the property rather than just them doing it themselves? So here's a question that you should think about it. Okay, so why does your boss hire other people? It's either because they don't have the time to handle everything, or they simply just don't know how to do certain tasks. Now, similarly, most landlords either don't have the time or the knowledge about how to run a business like this. Okay, managing short-term rentals is not a 100% passive business because most landlords, they just want a 100% passive income stream. And I'm a landlord myself, telling this from personal experience. We're not just listing these properties on Airbnb as is. Okay, we're making a lot of changes to them. And that's why a lot of my students are able to secure 2 and 3 year leases with landlords. We have hundreds of people like this that are signing such deals to convert their properties into short-term rentals. And no, you don't need sales experience to talk to landlords because they're already looking to rent out their properties. Kayla's a dentist. She's one of our students. She signed the lease with the very first landlord that she talked to. Then we have people like Alvaro, Kyle, Faith, Daryl. There's hundreds of people that are signing such deals. And I'm going to show you exactly how to pitch landlords and exactly what to say. So that way it's a no-brainer for them. This is a win-win for both parties if you position it right. Okay, so with this method, you can pocket $2,000 plus per month in cash flow. It's way higher than other models. It has less moving parts, less vacancies, means there's less impact on the revenue. It's in a rapidly growing industry, and it just takes a few hours per week to manage and set up. And so, yes, it has all the advantages of the short-term rental model. Plus, it also helps us overcome the disadvantages of other models. Okay. Now, the biggest downside here with arbitrage is that you're not getting a bunch of equity, or you're not getting any equity just because you don't own the property. Okay. But this is a cash flow. This is a cash flow play first and foremost. You can scale your monthly cash flow first, and then you can start to shift to the traditional real estate model, or you can go to buying properties. So it's kind of like think of it like a stepping stone to get there as quickly as possible. Now, it took me over 3 years to build a cash flow of $6,000 per month with my long-term rentals. But with Airbnbs, from January 2022 to March of 2022, I went from $6,000 to $12,000 per month. And the next 4 months, I went to about $18,000 per month with just a few properties. And so with Airbnbs, I literally 4x'd my 39 months of real estate success in just 7 months. And so with this session, I want to help you skip this phase of trial and error. And today, my properties are making over $20,000 per month for my properties. Or this is one of the biggest things that a lot of people think about when it comes to Airbnbs, right? Because they think, oh, it's dead. And so what I want you to do is I want you to make your decisions based on data instead of drama that you see on the news. Because like their job is to just get clicks, right? But don't let that stop you from making money. Because we have students doing this outside the US, okay, as well. We have Andrew who's making $2,500 per month from his property in Mexico from the US. Kamari has one in Mexico as well. We have another person in Puerto Rico, Budapest, Hungary, even Thailand. So this is a business where you shouldn't let your location stop you from making money. And you're going to see how straightforward all this is once I cover all the pillars. So let me show you how to actually analyze a deal so you know if it's worth buying. Okay, this is for the people that are looking to buy the property, take advantage of the tax benefits and the equity. So the 4 things we need to determine whether a deal is good or not is first is the location. Second is the purchase price versus the market value. The third is the cash flow and expenses. Fourth is the exit strategy. So we're going to cover each one by one. By the end, you're going to know exactly how to evaluate any property. Now, if you find the right market and the right property, you can do everything else wrong, but still make money. That's how important this step is. Because if your property is in the middle of nowhere, don't be surprised if the bookings don't come in. The good news is you don't need a beachfront Malibu property. All you have to do is follow these few steps. And this also answers a common question I get, which is what if I acquire a property, but I don't get bookings and I'm stuck paying the rent? And I totally get where they're coming from, okay? Because most people don't understand why some properties get booked throughout the year while others keep struggling. And the biggest reason this happens is because they're in the wrong location. Okay. So this is the most important factor. A great property in a bad location is still a bad investment. So here are six things to check. First is the population growth. Are people moving into the area or leaving? Because growing cities have rising demand and shrinking cities have falling rents and also property values. The second are job market. Okay. Is the economy diverse or dependent on one employer? So tech hubs, medical centers, and cities with multiple industries are going to be safer bets than single factory towns. The third is tourism demand. For short-term rentals specifically, why would someone visit this area? So think beaches, mountains, national parks, downtown districts, event venues, hospitals with visiting families. You need a reason for people traveling there. The fourth thing are short-term rental regulations. Some cities ban short-term rentals outright. Others require permits, limit the amount of days that you can rent it out, or restrict non-owner occupied short-term rentals. So just make sure that you check the local laws. The fifth is seasonality. Okay, is the demand year round or is it concentrated in a few months? A ski town might do 70% of its business in the winter. A beach town might be dead from November to March. So seasonal markets, they can still work, but you need to account for the slow months in your projections. The sixth thing is neighborhood specifics. Okay, so crime rates, school quality, proximity to attractions. What other Airbnbs in this exact neighborhood are charging and how they're performing? Is the area improving or declining? That's something that you really want to check. Now, here's where you can find this data. So you can go to US Census Bureau for population trends, the Bureau of Labor Statistics for job growth. You can go to AirDNA for short-term rental, revenue, occupancy, seasonality, city and county websites for the regulations and permit requirements, local news for employers moving in or out. Okay. You can also use AI tools like Gemini, Perplexity as well. You can ask them to pull out this data on a specific market. They'll compile it faster than you can search it manually. But you also definitely want to double check, especially for the regulation stuff on the county website. So here's an example. Let's say you're comparing three cities. Okay, so let's say you're looking at Austin, Texas, Cleveland, Ohio, Tampa, Florida. And you say in your findings, you see that Cleveland is cheap, but it's shrinking. Austin is growing, but it's expensive with stricter rules. But Tampa has growth that's reasonable prices and also mixed regulations. Now, there's no single best city. You're just looking for the combination that matches your budget and also your risk tolerance. Now, the second part is the purchase price versus market value. You make money when you buy and not when you sell. If you overpay, you're starting in a hole. Even a great property can become a bad investment if you pay too much for it. So here's how to know if the price is right. Look at comparable sales from the last 3 to 6 months. So you want to check price per square foot, get an appraisal before closing, and the best deals come from motivated sellers. So think foreclosures, divorce sales, estate sales. If market value was $250,000 and you negotiate down to $210,000, you just created yourself $40,000 in equity before you closed. Now, the third part is cash flow and expenses. This is where a lot of people mess up. Okay, they overestimate revenue, they underestimate costs, and then they're shocked when there's no profit. Okay, so a few steps that I follow. The first step is to estimate the revenue, calculate all the expenses, and then see what's left. So let's go through each one. The first step is to estimate the revenue. This is where AirDNA comes in. So first, I'll go through this here in a second with AirDNA, but in more detail. But the first thing is you want to start on Zillow or Redfin. Okay, so look for properties for sale that stand out. So think nice pools, vaulted ceilings, prime location, and good bones. Then once you find an address you want to investigate further, you want to copy the address and then plug those numbers into AirDNA. Okay, AirDNA is going to pull the estimate to see how much your property can generate as a short-term rental. It's going to show you the average daily rates, occupancy rates, and projected annual revenue based on the comparable listings. Now you're going to let's say you're looking at a 3-bedroom house near the beach in Destin, Florida, for example. AirDNA is going to show comparable properties, let's say averaging $65,000 per year, average daily rate, $250, average occupancy is 70%. Then you want to filter for your specific property. Okay, don't just take the top line number. You want to filter by the amenities that matches the comparable listings. And then the site's going to spit out the revenue projections for the properties that actually match what you're buying. And then you want to study the top performers. What are they doing differently? Do they have better photos, higher ratings, unique themes? That's going to tell you what's possible if you execute well. Now, the next thing is you also want to study the bottom performers. What's dragging those down? Bad reviews, poor location, outdated decor. That's going to tell you what to avoid. And also be conservative, okay? So AirDNA is going to show the averages, and you want to just make sure that you're running the numbers conservatively when you find your property. And then I like to run the scenarios. I like to run a worst case scenario, a likely scenario, and a best case scenario. If the worst case scenario still makes money, then the deal is likely worth pursuing. If worst case loses money, then you want to walk away. Okay, now I know you might think that this is super complicated, and that's okay. That's usually the first reaction I get from people. So what I want to do is spend the next few minutes doing this live for you guys. Okay, so let me know in the chat. You guys ready? Give me one in the chat if you're ready for the live demo here. Give me one in the chat. Ready for live demo. Okay, good deal. All right, so what I'm going to do here is I'm going to do this for arbitrage, okay? Because I think most of us here are probably interested in the arbitrage model. So it's the same thing, but I'm going to show you a little bit of quick example for the purchase, but also I'm just going to run this scenario for arbitrage here first, okay? All right, so first thing you want to do is go to Zillow.com for rent. Especially if you're going to go look for properties that you're looking to rent out for arbitrage. So all you have to do is you can just filter for rent on Zillow.com. You can filter by your budget, and then you can start looking for properties that are available for rent. Okay. But let me show you how to do this even quicker and even better on AirDNA. So I'm gonna head over to AirDNA here. So let's say we want to go and analyze this market here in Charleston. Okay. So let's say on Zillow.com, you found a property that looks interesting, available for rent. So let's say for this property, for example, it's a 3-bedroom, 2-bedroom, can sleep up to 8 guests. This property was listed for rent at $3,100 per month. Now, I have no idea based on the revenue that it's projecting here, if this is going to be a good investment or not. Okay. So that's why we have to really dig into the numbers here first. And so that's why I have this handy dandy calculator here. So let me just kind of walk you through exactly how this works. All right. Okay. So first, we want to plug in the bedrooms, common space count. The common spaces, anything like the living room, game room, etc. These rooms are really important to plug in, as they're going to plug into these numbers here. Okay. So let's put that into here, and let's look at the middle section here. So like I said, this particular property was listed for rent for $3,100. So I'm going to put that into that security deposit, $3,100, other fees. And so these numbers are pulling into here. So because this property is a little bit bigger, we're looking at initial investment of about 14 grand. Okay. Now for the fun part. So we saw here that this property can do $192 a day at a 65% occupancy. So let's just take this at face value for now and plug those numbers in. Okay. So we're going to plug in $492 at a 65% occupancy rate. Okay. Hit enter. And then we're going to plug in all of our operating expenses. So that's the monthly rents, insurance costs. And if you're purchasing the property, obviously this will be the mortgage, utilities, cable, internet, pest control. We're also going to set aside an expense here per month to pay a virtual assistant to actually manage this for us. So a couple of numbers I like to look at. The first is the cash on cash return metric. So that means the amount of cash you're getting back for the amount of cash that you put in. So for this example, we're getting back, we're putting in $14,000 and we're getting back about $52,000 in this scenario. So we take those numbers, this number divided by this number, and that's going to give us the cash on cash return. In this example, we're getting a 373% cash on cash return. A lot of people are probably asking yourself, okay, cool, I don't know what that means. So just to put that number into perspective, I like to get anywhere between an 8 to 10% cash on cash return for my long-term rentals. So as you can see, this number blows that out of the water if these numbers are true, right? But again, I always like to do worst case, likely, and a best case scenario here. Okay. So instead of this, let's say instead of $492, let's say we could do $350. Let's even bring it down to even more. Let's say $295 a day, 65% occupancy. So we literally slash this revenue by nearly $50,000. Okay. So even in a worst case scenario here, we're still looking at a 49% cash on cash return and still going to be cash flowing a few $100 per month. Okay. Not bad, right? Now, I would say that the first number that we looked at was probably the best case scenario here. Let's put an average scenario. Let's say it's a 295 and not instead of the 492. Let's meet somewhere here in the middle. Let's say we can do about $390 per day, 65% occupancy rate. We're looking at a 205% cash on cash return at a $2,400 per month cash flow for this property. Okay. So just let that sink in. That's why I'm such a huge proponent of this model. right? Let me go back to the slides here. Okay, now the expenses. Let's talk about that real quick. So here's two categories. So there's a fixed cost and also the variable cost. So the fixed costs is these are going to be what you pay every single month, regardless of bookings, right? So think the rent or the mortgage. So the mortgage in this example, let's say we're looking to buy the property. Let's say we're going to spend $2,400 per month. Property taxes about $417 per month. Insurance. We also have the utilities and all the other expenses. Now let's talk about the variable costs. Okay, this is going to depend on the bookings. So cleaning is a variable cost. The supplies and also the platform fees are going to be the variable costs that we have here. And the step number 3 is to run the full numbers. Okay, so let's run the numbers now for the purchasing side. Let's say purchase a property, $500,000, down payment is $100,000, loan is $400,000 at 6%, plus the closing costs, plus the furnishing, we're looking at about $140,000. Okay, so the monthly expenses comes out to, let's say, $5,600, and then the revenue conservatively comes out to $93,000 after we ran out the numbers. So the cash flow is going to be the $93,000 subtracted by the monthly expenses, comes out to $25,000 per year that you get in cash flow from this property, plus you get all the other benefits that comes with owning the real estate. Now let's take a look at the full picture. Okay, so the year one total, we have the cash flow plus the equity buildup, plus the appreciation, plus the tax savings from the bonus depreciation. So the net benefit from this one property is over $100,000. Okay, so your $140,000 investment generated $100,000 in year one value. That's a 72% return. Just let that sink in. Okay, for someone in a high tax bracket, the depreciation benefit alone can exceed your entire down payment. So that's why I'm such a huge proponent if you want to go and if you have the capital available to go the ownership path. Now let's talk about the exit strategy. Now, before you buy, you need to know how you're going to make money. So we talked about that. So the four options are hold for cash flow, sell for profit, refinance, or you can 1031 exchange. Okay, so that we have some options here. Now let's talk about 4 numbers that keep you safe. Okay, these are the numbers that investors use to evaluate deals quickly. And if you know these, then you don't get burned. So let's go through these quickly. First is the 15% rule. Okay, so it's the annual gross revenue should be at least 15% of the purchase price. So on that $500,000 property, the revenue needs to be at least $75,000 per year to pass. This is different from the 1% rule that you hear about for long-term rentals. But for short-term rentals here, I use it as a quick filter, 15%. Okay, if it doesn't pass this, then usually it doesn't make sense to dig into it further. The second is the cash on cash return. So it's the annual cash flow divided by the total cash invested. So let's say if you want to do, for this example, it's going to be much higher usually for short-term rentals, but $6,000 cash flow divided by $140,000 invested equals 4.3%. Okay. Pure cash flow investors want usually 8 to 12% minimum. For short-term rentals, you can even shoot for 12 to 20% depending on the deal. Third is the cap rate, the net operating income divided by the purchase price. So the NOI is the revenue minus the operating expenses, not including the mortgage. And so $58,000 revenue minus $35,000 in operating expenses equals a $23,000 NOI. $23,000 divided by the $500,000 equals a 4.6% cap rate. Below 5% is typically weak unless you're betting heavily on appreciation. Now, the fourth thing is DSCR. So the net operating income divided by the annual debt payments. And lenders typically use this to see if the property's income covers the mortgage. And so in this example, $23,000 NOI divided by the $31,932 annual mortgage equals 0.72. Lenders typically want to see 1.25 or higher for investment property loans. Now, here are the golden rules for not losing money. Okay, you can take a screenshot of this. Whatever you need to do, write them down, whatever you want. Okay, so the first thing is to use 10 to 15% below AirDNA revenue estimates. The second is to use 5 to 10% percentage points lower occupancy than the market average. You want to budget 1 to 2% of property value for maintenance every year. The fourth thing, you want to keep at least 6 months of expenses and reserves before you buy. The fifth thing, you want to run worst case scenarios. If it loses money, then don't buy it. Number 6, if the deal only works when everything goes perfectly, then it's not a deal. Okay, so that's the deal analysis: location, price, cash flow, expenses, and the exit strategy. So now you know more than 90% of people looking to buy real estate. The difference between making money and losing money is running these numbers before you buy and not after. Okay, so let's say you found a deal, the numbers work out, and now you need to pay for it, right? So here are 5 ways to finance a short-term rental. Okay, I'm going to tell you exactly who each one is for as well. First option we have is a DSCR loan. This is the investor's loan. The bank doesn't look at your W-2, tax returns, or your debt to income ratio. They care about one thing, and it is that the property income covers the mortgage. So here's how they calculate that. Okay, so the DSCR equals the property's net operating income divided by the annual mortgage payment. And most lenders want 1.1 to 1.25 minimum. Terms here typically down payment 20 to 25%. Interest rates are going to be a little bit higher, about 1 to 2% percentage points higher than the conventional mortgages. Credit score, you need at least 680 for best rates. This is great for people that are self-employed, looking to write off expenses, business owners that want to lower tax brackets, or they have really complicated tax setups. And this isn't for people this isn't for properties that don't cash flow well. So DSCR loans are ones typically for short-term rentals that do cash flow. The second option is just a conventional loan path. Okay, shows your income, your credit, your assets. They're going to give you a mortgage from that. So bank looks at your debt to income ratio. Typically, they want to see less than 43 to 45% of your gross income. The terms, down payment, anywhere from 20 to 25%. Interest rates are going to be better here, but they want to see a cash flow or credit score of 720 plus for the best rates. And then also most lenders stop at 10 finance properties. So just keep that in mind. There is a property limit. And this is great for people that have W-2s with steady income and good credit. The third option is a second home loan. Okay, a lot of people don't know about this one, but this is the 10% down option. If you're buying in a vacation market, you can use a property as a second home and get better terms. And so, like I said, you can put down as little as 10%. Interest rates are going to be pretty similar to conventional loans. You want to get at least 680 to 700 plus credit score for the best rates. And the difference here is that you're going to be coming out way less out of pocket, get good rates, but you just can't. If your property isn't, or if the property you're trying to purchase is in your primary market, then you can't use it. All right, the fourth option is the FHA loan. Okay, this is a house hack special. This is a government-backed loan. You get loan down payment, and it's easy qualification. Now, the biggest catch here is you have to live in the property for at least 1 year. So this is great if you want to just live in this property and set it up while you purchase it. And then the down payment here, 3.5%. Credit score is you just need like about a 600 minimum credit score. And all you have to do is live in it, set it up, and then you can move out after a year and you got yourself a property with minimum down. Now, the fifth option, if you're a veteran, you can use the VA loan. Okay, this is awesome. If you're active duty, veteran, National Guard, this is one of the best deals in real estate. Now, the terms are mind-blowing. Okay, down payment is 0%. Interest rates are typically 0.25 to 0.5% below market value. And so let's say your purchase price, $400,000, down payment is $0. The VA funding fee is usually about $8,600, depending on the purchase price. You can roll it into the loan. And so the monthly mortgage comes out to $2,700. So you just bought yourself a $400,000 property with zero cash. You can live in it for a year, you move out, and then you can rent it as a short-term rental. This is the single best financing option. If you qualify, if you're a veteran, definitely take advantage of this. Now, the sixth option is seller financing. Okay, so the seller essentially acts as the bank, and you don't have to get a bank involved. So here's how this works. So the seller owns a property free and clear. You negotiate the down payment, interest rate, the monthly payments directly with them, and you make payments to the seller instead of a bank. So an example, let's say the property is worth $300,000. You offer $20,000 as a down payment, and then you pay the rest over 15 years as 16% interest. The seller gets monthly income instead of a lump sum. So let's say the terms here, you negotiate that. The interest rate you can negotiate as well. Credit score, doesn't matter. Closing is also faster, fewer fees, and no bank approval. This is great for people who can't qualify for traditional loans, and you have a little bit more time to go and dig for seller financing options. Okay, so here's a quick reference that you can screenshot, whatever you need to do that fits for you. So if you're a veteran, VA loan, zero down, this is awesome. If you're buying your first property and willing to live in it, FHA can work well for this. If you have a W-2 job with good income and over a 720 plus credit score, go the conventional route. You're self-employed, already have multiple properties, you can go DSCR. And if you found a motivated seller who owns a house free and clear, you can go the seller financing route. Okay, now let's talk about the IRS loophole that allows you to make all this income 100% tax-free. It's the self-directed IRA. Okay, we saw how this worked yesterday, but here's a quick recap if you don't remember. It's a retirement account where your money grows tax-free or tax-deferred, just like a normal IRA. But the difference is control. You get to decide what to invest in instead of being limited to mutual funds. Okay, you can put your money into real assets like real estate, private businesses, crypto, etc. Now, this is how you can beat the typical 8% return of a traditional IRA. And if you don't have enough cash on hand, you can just roll over part of your 401k tax and penalty free. So let's say a property can generate $2,000 per month, $2,000 per month. Okay. So let's use that as an example. When your property makes money, it goes straight into your IRA without being taxed. So let's say you take action today, start your journey, you comfortably set up one property every 3 to 4 months. By the end of 12 months, you have 3 properties. Let's say they're making $2,500 per month each. That's $90,000 per year. Now, there are 2 ways to use the self-directed IRA to make money with Airbnb. First is the direct property ownership. So your IRA buys a property and you rent it out on Airbnb. The second is through the arbitrage method. So your IRA leases a property, you sublease it on Airbnb at a higher rate. Both ways can help you grow your retirement savings through short-term rentals. Now, the best way to set this up is through an LLC inside your IRA. You own the LLC, or you own the IRA owns the LLC, and then the LLC handles the property. Now, this is better than a regular IRA with a custodian. Custodian is basically a company that looks after your IRA money. With a regular IRA, you'd have to ask them every time you want to do something with your cash. So with an LLC inside your IRA, you can get checkbook control. So there's no middleman and you get faster decisions. The LLC has its own bank account funded by your IRA and buys the property in its name. Now, some quick rules. You can't use this for personal use, so you or your family can't stay in the property. Your IRA can do business with the IRA owner, spouse, your kids, their spouses, your parents, grandparents, anyone who advises you on your IRA. And you can't manage the property yourself. Okay, you have to hire someone else, which isn't a disqualified person. But that's actually a good thing because it keeps the business semi-passive. So you're going to hire cleaners, handymen, movers, maybe a virtual assistant. That way you don't have to be on site and you can manage all the properties remotely. Now, lastly, you can't use IRA funds for your personal expenses, and you're going to get access to the profits at retirement. But the upside here is that your gains grow tax deferred. And if you're asking yourself, how do I set this up? It's pretty simple. Just don't DIY this. You want to hire experts who do this for a living. They're going to handle the setup. That way you need to understand just the big picture. I mean, really think about it, right? People like Jeff Bezos, they're not stressing over tax write-offs, right? They hire their pros. So that way they can focus on growing the business. And that's where the real money is anyway. So here's a quick checklist on finding the right self-directed IRA custodian. You want to first ask them about the real estate experience. You can ask a question like, okay, how long have you been handling real estate investments in IRAs? You want to look for someone with at least a few years of experience that can help you set this up. Second thing, have you worked with clients doing short-term rentals? Not mandatory, but it's going to help because Airbnb has unique needs and experience matters here. The third is understand their fee structure. You want to ask about their setup, annual and transaction fees, and you want to avoid custodians that charge a percentage of account value. You want to look for flat fees instead. Next, you want to ask them if they offer checkbook control through an LLC structure. That's the way it's going to give you more freedom to make quick decisions. The fifth thing is ask if they offer prohibited transaction guidance. Okay, you want a custodian who can flag what's allowed, what's not allowed, and ideally review the investments before you commit. And don't just pick the cheapest, find someone who actually knows their stuff. Okay, I know we just covered a lot. All right, so let me know in the chat if that's starting to make sense and why these short-term rentals are so powerful. Give me one in the chat if you see why this strategy can be so powerful if used correctly. Okay, cool. So let's go through the summary here. Here's a simple breakdown. Self-directed IRA, no taxes, but you can't touch the money. But you can also just go regular LLC, pay taxes on it, and use the cash now and however you want. Okay. Okay. So we just walked through how to analyze a deal if you're looking to purchase, and also the short-term rental or the arbitrage route. But now, not everyone's sitting on a bunch of cash to go and purchase these properties outright. Okay. So that's why I want to talk a little bit more briefly or a little bit more in depth on our Airbnb arbitrage. So let me show you how this works. I'm going to break this into 4 pillars. I'm going to go through the finding the properties, closing the deals, setting up your property remotely, and then delegating this for your day-to-day operations. Okay. The last 2 pillars are applicable even if you do property ownership. Okay. So don't check out. This can be applicable even if you purchase or if you go the arbitrage route. So pillar number 1 is the 4 simple steps that you should follow to find the profitable market and property. Pillar number 2 is how to close win-win deals. Pillar number 3 is how to set up your property without leaving your house. And then number 4 is how to automate this so it doesn't turn into another job. Now, the first pillar is finding the right market and the property. Now, so we follow the same process as we did for property ownership using AirDNA, except we find the properties available on rent on Zillow. Now, let's talk about closing win-win deals with landlords, okay? So I created this whole system because I'm an introvert myself. And so if I can be reasonably successful at this, like anybody can do this. It's not as hard as you think. So let me break it down. So the first step is if you want to catch a fish, you need to think like a fish. Same thing with landlords. It's not about what you want, it's about solving their problems, right? So, quick story, there's this tennis instructor named Brian. He was struggling to get clients. When he told people that, he wanted to teach people how to play tennis, nobody cared. But once he reframed it and said, okay, I help parents by tiring their kids out on the tennis court so they come home exhausted, suddenly everyone was interested. And the reason is because he saw the real problem, right? And the same thing with landlords. Don't just say, hey, landlord, I just want to rent out your property on Airbnb. You need to understand their pain points, and I'm going to show you how and position yourself in the situation. Now, I'm a landlord myself. I have over 40 traditional rental units, and so I've been on both sides of this conversation. And here's what's going through the mind of every landlord when they want to rent out their properties. They want steady passive income, they don't want any work on their end, and they don't want their property to get damaged. So if your pitch solves all these problems while you also pay them an extra bonus, then why would they say no? And you might be thinking, why would the landlord let me sublease the property rather than just doing it themselves? Again, why does your boss hire other people? Simply because they don't know how to have the time to do everything, or they can't do all the tasks themselves. And most landlords don't even have the time or the knowledge to run an Airbnb business, right? So that's why this can be 100%, running this business isn't going to be 100% passive. And that's why most landlords will pass this over to you. It's free property management for these property owners. And usually landlords have to pay 10% of gross revenue for this. So it's not that they're doing you a favor by signing a lease. It's a win-win scenario because if they choose a partner with you, they're going to be earning more money and they're also going to be 100% passive business without paying that 10%. You just have to convince them to rent it to you instead of somebody else, right? So in step number 2, you want to explain to them very clearly what you do. So when you're on the phone with them or you're via email, you can say, a little background on me. I'm a real estate investor and I operate a vacation rental company. I want to see if it's going to be a good fit for one another as I differ from a traditional tenant. This arrangement has worked out extremely well with other landlords and property managers, and I'm confident I'll be one of the most valuable tenants you've ever had. Step number 3 is you want to explain to them why it's a win-win scenario. And you can say this because landlords want steady passive income. So you tell them that. You're a business, you're not a tenant who just leaves whenever they want. So rent's always going to be paid on time. And also, secondly, landlords don't want extra work. So you can tell them that. I manage everything from top to bottom. Most tenants live in a property daily. After each turnover, you're spending hundreds, if not thousands of dollars to make your rent ready. But with you, there's going to be less wear and tear because it's in your best interest to keep the property in tip-top shape. Plus, you're going to have professional cleaning team going into the property 2 to 3 times per week. So that's going to be a win-win. Now, when they say, I don't want my property to get damaged, tell them that you're going to be screening the guests before accepting their bookings. And by the way, here's a quick way you can do that. Okay. So you can avoid the worst types of guests by avoiding the ones that give vague answers, have history of bad reviews, ask for discounts, or try to book on the same day. You watch out for these red flags and you're going to avoid the most problem guests. You're also going to tell them you're going to install noise detectors to avoid parties. And then worst case scenario, you're going to cover the property with your own liability insurance plus the $1 million coverage in Airbnb with Airbnb cover. Okay. So that way they're protected from every single angle. Then step number 4, after you reach an agreement, here's how to get some freebies. So first, you want to push your lease date out by at least 3 to 6 weeks. That way you're not paying rent until you get your furnishing done. So let's say if rent is $3,100, pushing it out 3 weeks is going to save you $2,100. And then if you have good credit and payment history, ask to pay only half the security deposit. That's another $30 or $1,500 saved. And if they ask why, just tell them you're reserving that budget to invest back into their property to create a better guest experience. One of my students, Lindsay, had her security deposit dropped from $3,400 to $1,000. So this approach works. And then once you secure the property, you want to send the big furniture directly to the property. That's going to be another couple $1,000s that you save on U-Hauls, storage units, etc. Now, if someone presented me this offer and executed their pitch well, I would 100% say yes to this. In fact, I've used these exact same points while pitching other landlords for this bridge method, and it's worked like a charm. One of my students, Kayla, is a full-time dentist, wanted extra income. She told me that her and her colleagues are always looking for ways to retire early, usually with long-term rentals or medical buildings. Now, obviously, with that method, the upfront costs are huge, and that's when she found the bridge method. And unlike her dental practice, which took years to become profitable, here she could see ROI in just a few months. And within 7 days of starting her journey, she closed the first landlord that she pitched. And fast forward about a year, that first property has brought in over $100,000 in bookings. Now, again, these results aren't typical, I'm not saying that you're going to close your very first week or the first landlord that you talk to, but if you show the landlords how this is a win-win scenario, they're going to be open to this. Now, another one of my students, Jenna, approached a landlord to do Airbnb arbitrage with their property. That property had received over 400 offers, and many of which were similar to what Jenna offered. So obviously the odds were heavily stacked against her. Now, at first, owner was asking for references, provided them, but after they had a proper chat, the owner declined all the other proposals and closed a deal with Jenna. And the reason here is because the property owner was impressed with her strong pitch. She came across as someone professional, easy to work with. Owner didn't even call the references because he didn't feel the need to do so. Okay. So this is how perfect example of winning trust. And while pitching the landlord, she followed this negotiation script, and it's a script that contains the exact approach that I just taught you. Now, after you sign the deal, the next step is to set this up remotely. So I made over $660,000 for my Airbnbs in the last 12 months, and I set them all up without leaving my house. So let me show you how I set this property up in particular for my short-term rental that's 500 miles away from my city. Here are the before and after photos. If you build a good team, there's no need for you to visit the property in person. The way I operate my business is by having 3 key team members. So it's a handyman, a mover, and a cleaner. Okay, so the property is located in Arizona, found on Zillow, is available for $4,100 a month. After the lease is signed, it was time to order all the furniture and make the property look better. Now, the key here is to get the right decor and furniture that's durable but doesn't break the bank. Okay, so I prepare a furniture list to make sure that I'm not starting from scratch each time. Here's an example. It's the modern cabin retreat. It's designed with the help of my interior designer. Okay, so I get a checklist for every room, and then that just makes it easier to replicate. Anybody can do this. Then I track all the orders inside the sheet. Here I can check if an item has been delivered, pending, and so on. Paid a handyman to move all the furniture inside. Then I paid a team of movers to unbox everything. And then later had my cleaners go and verify all the work, manage this via phone and FaceTime. And here's the result. So as you can see on the screen, it was 500 miles away from this property, but I had my team do all the groundwork and it wasn't a problem. So it's possible to set up a property, even if you're in a different state or country. And you can use tools like the Schlage locks to secure your property. It's a keyless entry keypad that you can operate from your house. I also have a Ring floodlight camera that's outside of my Airbnb, so I can keep an eye on everything as well. And through this, I can track packages, see the number of people coming through, peace of mind, and that way everything systematized, and that way everything is plug and play. My students and I, we follow this remote setup checklist that guides us every step of the time. For example, Kiana has been working in finance for over a decade for companies like JP Morgan and Chase. She has 2 properties in Scottsdale, and some people call it one of the most competitive markets in the country. She applied my methods, got a $38,000 booking within the first 3 months of going live. And in fact, she left her 10-year finance job to become a full-time Airbnb host. Okay. So now she manages her Airbnbs while traveling around the world. Now, this brings us to pillar number 4, okay, which is all about how I automate most of my business so I can spend more time with my family. Now, what you're seeing on the screen is a picture of my tax returns back when I was working my corporate job. Me and my wife used to make over $380,000 per year at our 9-to-5s. And yes, this money was great, but we had to bust our butts to get this level of income. We had no control over our time. In the back of my mind, I knew that this could disappear overnight with a single phone call. And then when I realized I could make the same amount of money with Airbnbs, I knew I had to figure this out. And I wasn't trying to make more and more. I just wanted to make sure that I had side income coming in so that way I didn't have to work if I didn't want to. And the best thing about this model is you only need a handful of properties to replace your income. You don't need hundreds like most real estate investors chase. And it might look cool on paper, but managing that many is a nightmare. And now we've been able to replace our jobs, and it's got this life has this newfound energy. And a lot of people might not agree with me here, but I live by different principles. Because I see a lot of people tell me, Preston, you should scale your business to 100 or 50 Airbnbs. You can make X amount of dollars. But right now, I just don't care about that. My priorities are crystal clear. I want to be there for my kids' games, their school plays, and so on. And I want to spend as much time as I can with my sons. Okay, 10 to 15 years, they're going to grow up. Even if I make millions of dollars, I'm not going to be able to spend as much time as I can with them. Okay, so this is my only chance. And obviously, I'm not getting any younger either. So my life goal is to spend as much time with my family as possible. And then I want to help other people who are looking to do the same thing. Like if there was a slide that described my entire life, it's on the screen. Most days, my work is done by 3 p.m. And the rest of the time, spend time with my family, go on dates with my wife, nothing exotic, nothing fancy. But I enjoy the slow life. And that's why I love short-term rentals, because I see people quitting their jobs to run their own business. But the problem is now they're trapped inside of it. Because if most of your business can't function without your involvement, that's literally just another job, right? And that's where secret number 4 comes in. It's going to help you scale your business without putting in more time. It's going to help you run it on autopilot. And a lot of short-term rental owners, they use property management companies, not realizing that they're taking 20 to 35% of your revenue. So to put that into perspective, if you're doing $100,000 per year in revenue, their management fee is 27%. They're literally taking $27,000 per year out of your pocket. So let me show you how to do this at literally a tenth of the cost. Now, I want to clarify, while this is highly automated and semi-passive, this does not do nothing and make money, right? Now, during my initial days of running Airbnbs and real estate and other businesses, I was overwhelmed and exhausted. Okay, I didn't know how to scale this stuff further, and I had no idea if I wanted to continue what I was doing. Then I talked to a mentor who told me he was automating his businesses with overseas virtual assistants. And I felt like this huge weight was lifted off my shoulders. So dove in, did the research, spent thousands of dollars on mentors and different programs, and made a plan. So I followed it step by step. And before I knew it, I only needed an hour per day to keep my business running. Now, of course, I work more like 4 or 5 hours, but that's because I want to. And having a business is not about working from the beach. It's about not having to work when you're on the beach. And businesses like Airbnbs give you that option. Okay. So the first step you want to do is go on a site like onlinejobs.ph and put out a listing that you're hiring for an Airbnb customer service rep. Second is the interview. You want to ask them a series of questions. I like to check their English, do a quick role play chat to see how they handle an angry guest, and ask about their experience. Once you hire them, you want to clearly define their role and don't expect them to read your mind. Okay. You want to make sure that they can respond to guests quickly, use automated messaging, qualify guests, and make sure that the expectations are clear. Okay. You can document all this. You don't need to have a 50-person team either. I have literally one virtual assistant that manages my entire multi-million-dollar portfolio. I have a student named Kirk. He's a full-time nurse. And you know how if you're been in healthcare or you know someone in healthcare, you know that they're working 12-hour shifts alternating between day and nights. But despite all that, he was able to manage to acquire 3 absolutely killer properties. And in the first 6 months of the year, he was able to generate close to $200,000 from his 3 properties. So if you're sitting there thinking, I don't have time for this, or I'm too busy with my job, this is what Kirk is doing, working as someone who's working in healthcare. Here's what happens when you actually apply this stuff as well. So Dustin, he's another one of my students. He used to work a corporate job, but it never started a business. So he started researching side hustles, and the turning point really came when his girlfriend's mom passed away at 62. And she was working her entire life, saving in her 401k and Social Security. But because she wasn't at retirement age, she couldn't access most of that money for medical bills. So imagine working your entire life, not being able to use your own money when you need it the most. And that he said that really hit him hard. So after attending after joining the program here, initially he was stuck in analysis paralysis, right? But exactly after a month after starting his journey, Dustin signed the lease for an Airbnb that cash flows at $3,000 per month. Recently, he had his best month yet, $56,000 in net profit from his 7 properties. He said this business model works. And then he texted me the other day that he quit his 9-to-5 to go full-time in his business. Again, I'm not saying that you can expect such results, but it goes to show you the results that you can get when you have a framework to follow. And he's still only seen a tiny fraction of the success that we've been able to help. So just name a few people, just so I can give some shout outs to people that have been able to be successful with this. We have Wendy, who received $744,000 in bookings with its 737 nights booked within 12 months. We have Gary making $35,000 per month. Michael doing $12,000 per month. Brian, $2,000 from one property. We have Hampton that's crushing it. Grayson. We have Andrew, who is making $2,500 per month from his property in Mexico. We have Sonny doing $2,000 per month. Christopher doing $1,700. They're Burton brothers as well. Okay. So these testimonials are proof that this works. Okay. But they're not a guarantee. I can't promise you the same for you. What you get depends on what you do. So knowing what you know now, do you think it's possible to find a $2,500 a month property if you follow the process I explained in pillar number 1? Okay, let me know in the chat. Give me a 1 in the chat. If you follow the process, you can do that. All right. Now, do you guys agree that it's possible to create win-win deals with landlords? Plus, do you agree that it's possible to scale to multiple properties by automating and delegating most of your tasks? Okay, plenty of them coming in. Now tell me this. If you followed everything that I covered today and you repeat all the steps I showed you, would you be able to run a profitable business, Airbnb business? Okay, let me know in the chat. Okay, cool. Now, picture this. Okay, 1 year from now, you implemented what we're covering today. You have a property generating you $2,000 per month in cash flow. Now, your W-2 job, you get to keep it, right? You're still making $160,000, but now you're bringing in $190,000 per year in total. Now, your effective tax rate dropped from 35% to 25% because of short-term rental losses offsetting your W-2 income. You save 10 grand in taxes. You spend a couple hours per week managing your property, and now your coworkers are still relying on one income, still paying full taxes, still hoping for a raise, and hoping that it's their raise inflation or it's keeping up with inflation. Okay, but you don't have to worry about that because 1 year ago you decided to execute instead of just consuming information. That's when things will change. Okay. All right. So I know that was a lot of information and a lot of people I can see in the chat are uncomfortable, but that's exactly when breakthroughs happen. Okay. So we're going to take a quick break. Okay. The next session is going to tie everything together and show you exactly where we can help. Okay. So let's take a quick 5-minute break. You can stay here on this call here, and we'll be back in just a few minutes, and then we'll get into the last session. All right. So see you guys back here in a few minutes.